David, Michael, thank you for joining today. It's a pleasure to see you. We have a new administration, a week old, but this is clearly an administration that is hell-bent on changing the relationship between Washington and the economy. And you're seeing that manifest in a whole host of different ways, whether it be threats of implementing tariffs, mass deportations and changing the immigration system, reshaping the tax code. And I'm wondering how you're thinking about these unknowns, Mike, as it relates to the economy.
Yeah, I mean, it's a week old, but it feels like it's 3 months old. I mean, these guys have been, working pretty hard, pretty feverishly, and stuff has been leaking out. So, in many ways, I think the markets and people, our clients that I speak to daily, we're actually a little bit worried about some sort of big bang when the administration actually took office on the first day. And we did get a bunch of executive orders, but I would say the two big negatives that people on the equity side are worried about are tariffs and, of course, immigration enforcement, which are both growth negative in the short term and potentially inflationary. So, the fact that we didn't get this blanket tariff, I think was a bit of a sigh of relief. There were people a bit worried about that. And then as far as immigration enforcement and deportation specifically, that's going to be kind of staged. I don't think it's all going to happen at once. And our thinking generally has been that the sequencing of the changes are going to be probably more kind of net negative in the beginning, and then the positive stuff takes longer to manifest, whether it be taxes or deregulation. And I think the DOGE impact, which is I think the biggest wild card, is probably negative to begin, and then you get the benefits later on. So our general view is markets, we had digested a lot of good news coming into the election itself, and then the excitement around that, which I think was right. Stocks did really well, bonds sold off a bit, that makes sense. And now we're just going to have to digest some of that for the first 3 to 6 months. But we're pretty constructive on the back half of this year, where some of these policies come together. People can can adjust their operating models, and investors can understand the impact on both the rates market and other policies, and of course how that affects corporate America and the way they behave. David and I were chatting in the back. I mean, the biggest change, I think for corporations last time was taxes, and that was a huge windfall. And this time it's more about making businesses, more productive, the deregulation part, but also just getting out of the way and allowing them to operate and do what they do best.
Sure. So, David, when you're thinking about the new administration, as Mike said, some of these policies have the ability to cause inflation to creep back into the system. How does the Fed respond to this evolving dynamic?
Well, I think it's twofold. I think some of these policies could be inflationary. Some of them could be massively deflationary. The deregulation story, which I've focused on with our clients from the beginning, and even something we pushed very hard in the first Trump administration, is very disinflationary. And in fact, if you look at 2017, 2018, 2019, the first 3 years of the Trump administration, inflation was generally flat to downward throughout that entire period, even though growth was accelerating, particularly into 2019 and into the quarter before the COVID crisis. So I don't think there's a bias on my side. And in fact, if you made me pick a bias on inflation, I'd pick the deflationary forces from deregulation over the inflationary forces that might come from tariffs and immigration. And the one thing I would say is, not that I'm a believer in Fed models or any economic models, but if you ask the Federal Reserve people to run their a tariff structure, a unilateral tariff structure through their model, it doesn't come up with a lot of inflation. And if you ask them to put a big immigration culling into the model, it's actually the demand side that dominates slightly over the labor supply side, in that you lose a fair amount of demand, which actually becomes somewhat disinflationary. So I think there's a lot of politically motivated economic analysis out there that is quite anti-Trump policies, and that is to try to cast them in a negative light with inflation and slower growth. And I think I really find that I find that great because it just creates a whole bunch of people that are getting somewhat brainwashed into believing it's going to end badly. And I think it's a wall of worry that we could climb up nicely, and we've already started to climb up nicely. So I'm much more, I think, optimistic than what I see as the average economic analyst or macroeconomic analyst or strategist out there, that the deregulation is just a big dominating force. And I think DOGE is a added feature to that wasn't there in 17 and 18 and 19. And that's not deregulation. That's literally shrinking government. And there, you're really talking about a healthy positive as we reduce the crowding out that the public sector does, and we free resources that are being used in an unproductive way in government to be used in a much more productive way in the private sector. Kind of think about an anti-Japan or a reverse Japan story where you unleash a lot of productive disinflationary forces by reducing the size of the government. I think that's the big story. That's what I'm focused on. And we have a very Goldilocks outlook. We're back into our risk parity trades, which have been with us for many, many years since I started Jefferies and started at Jefferies 15 years ago. We abandoned them a little bit when the inflation spike happened, and we're heavily back into them now, probably as excited about risk parity as I've been since I started at Jefferies in 2010.
I think it's interesting you mentioned DOGE, because in my mind, the story is yet to be written on what exactly DOGE is or DOGE evolves to be. It already seems like we've been through, at least one or two iterations of that, and, whether their, ideas turn into follow through, is a big question mark in my mind. Are you thinking about that as a question, or do you think that DOGE will certainly bring out some waste and abuse and bring it to light and cause the government to stop programs?
I'll take that quickly and pass it over to you. I think you're already seeing it. I mean, he's stopped payments on so many things. He's stopping payments on everything related to DEI, everything related to those things they determine that are woke. I'm sure that all the management consultants that have been helping with those programs at every company are wondering if their check's going to clear in the next round. They probably won't. And you're seeing foreign aid go down. You're seeing domestic programs that they are cutting just get chopped. They're going to go into the DOD. They've already tried. They're going to try to go into state. I mean, these are morasses of spending that are very hard to dig around. But I think the optimism is there and the story is there, and I think it sells. It sells well politically to get up on a stage, whether it's J.D. Vance or whether it's Mike Johnson or whether it's your local House member or your senator, to say, hey, I saved some tax dollars for you and here's how I did it. Boom, 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 boom. This one kind of feels like what voters want to hear. So I just think they're going to keep selling it. And even if it's not as big as advertised, I think there's enough of a momentum to just stop the growth, which is more of what Reagan did, than literally bring it to a negative number. And that's, it's incredible numbers when you look at, 2020, I think government spending was 4 and change trillion. Now it's 6.5 trillion. I mean, we've figured out how to spend $2.5 trillion more in less than 4 years annually.
Well,
I mean, it's kind of wild.
Certainly, certainly debt and deficits have risen substantially. Mike, I guess I'll throw the follow on to you, which is, sure, there are certainly programs here and programs there that are available to be cut, but that's not going to change the, cost basis of the U.S. government. We know where the spending is, and that's in entitlements, and it's unlikely that those will be touched by DOGE. So, do you see the DOGE committee as being, much more than a messaging tool that the administration is going to use to talk about how the government operates?
Well, I think this is the most underestimated part of what this administration is going to try and do. I mean, it rarely comes up in conversations because people think, oh, they can't do it. It's just not going to happen. It's this freight train to third rail, all the excuses that, other administrations have given up on it. And to David's point, I mean, like the growth and the size of the blob has just been extraordinary. And he's right. If we just stop the growth rate and you can still grow the economy 6-7% nominally, that's how you solve the problem. And that's what the bond market cares about. It's not that they expect you to fix it today. It's the trajectory and the imbalance, and it has to see the light on the other side. So this crowding out feature that David mentioned, this has been something we've been highlighting for years. And it really does explain why the equity market has been so narrow. Okay, you think about the government, and it's caused the economic numbers to probably look better than it's felt for the average company or the average person, which means the Fed has to keep rates higher than is good for the average person, and that crowds out. So if you think about the U.S. economy, autos, housing, manufacturing, consumer goods, every commodity sector, semiconductors, NVIDIA. I mean, they've been in a recession for 3 or 4 years. I mean, so what I would love to see, and I think it's plausible, is they actually orchestrate a recession in government. Think about that. You orchestrate a recession in government, and it effectively liberates. Then it's like a big paperweight comes off these businesses, and they're allowed to operate more entrepreneurially and with less regulation, with less friction. And that is from an equity market standpoint, that actually creates incredible stock opportunities that haven't really been there for the last 2 or 3 years. These smaller businesses, these interest rate sensitive businesses, because if they're effective in doing that, the Fed will be able to cut, not because they need to, but because they can. And if that happens, and inflation expectations kind of stabilize, rates at 4.5%, by the way, is fantastic. That's a fine level. Mortgage rates would then be somewhere between 5.5, and price levels would be more stable, and incomes could grow faster than what inflation is doing. So that's the vision. That's the bullish view that I have. I think the transition from here to there is going to be potentially a little messy because maybe some of the headline numbers in the economy look a little softer. But when you think about a lot of these industries that haven't been growing, it's like falling out of the basement window. They're not, where are they going? They've been cutting costs already for years. And if you shrink the government, you take a lot of what I would say are good people in the government working on a bad team. Okay, you have good players on a bad team. You put them on a good team, and all of a sudden they become more productive. So I think there's a real story there that I'm probably more excited about that than really anything. Because if you're actually intellectually honest about Trump's first term, he did almost everything that he said he was going to do. It was quite effective, but the one thing that he failed miserably at was draining the swamp. Okay, he did not drain the swamp, period, end of story. And I think that's the one thing that if he were able to achieve that, it would be kind of a crowning achievement for his 2 terms, separated by 4.
It's a really important point you make. And if you remember in his first term, he came in with I think he had a majority of 40 in the House. Right. Today he's got 1 to 5, depending on how you look at it. And he keeps taking members out and putting them in the administration, so that's tricky. But they wanted to repeal and replace Obamacare. That's what he thought was the mandate. And they spent 18 months trying to do that, fighting a lot of other things like Russia collusion and all the things that were thrown at them, and they failed. And I think that really stopped the de-swamping effort. This time, they're not really going after healthcare very directly. I mean, I think they'll go after it on the side bit. But there's so many other places they're focusing on, and I think the odds that they get that done away from the healthcare industry, which is still a big part of it, are much higher. But I like your thought or your statement. It seems like a good commentary title somewhere. A bull market in government is a bear market on Main Street. And a bear market in government could very well be a bull market on Main Street. It fits very well with our theme, which is on my hat this year, LFG, which is less federal government, which is what it says on the back. The only way I got this through compliance was putting the less federal government on the back.
Small print.
Because, smaller print, but everybody, a few of the younger folks out there might understand the LFG acronym, or you can look it up on your Google and see what the dictionary of millennial terms says. But I think it's really, this is the most exciting thing going on for us. A smaller government and less regulation. And I love it that everybody's obsessed with tariffs and obsessed with immigration and obsessed with fiscal largesse, and they want to put their risk on trades on hold, because it just means they're going to have to buy them back later after we've pushed everybody into them.
So, regarding the deregulatory environment, I mean, that's a big piece of the MFA agenda over the next few years is going to be, working to cut red tape, turn the page on Gensler, make sure that this is an industry that can continue to thrive and flourish and that we aren't being held back by unnecessarily burdensome regulation. Not no regulation, because I think everybody agrees that there's a level of regulation that's good for both the industry and our investors, but certainly Gensler swung the pendulum way too far in the wrong direction. I want to turn the conversation to the Fed. So, David, we've seen the Fed in a fairly consistent rate cutting cycle. We'll see whether that continues. But at the same time, we've also seen a steepening of the yield curve, and the long-term rates have been, going up in a significant way. Has the bond market started to dictate terms to Washington, or do you read something else into this?
I don't think so. I don't look at a 4.5% 10-year note yield as some sort of bond vigilante returning. We had a massive inversion, one of the deepest inversions since the 1930s that stuck with us for a couple years. That was all Fed credibility related. I don't think Fed credibility is really on the docket, but I think there's a Trump term premium that kind of came into this. What's going to happen with issuance? How is Scott Bessent going to kind of maybe rectify some of the issuance-related criticisms that Janet Yellen got from the street in going too short? But look, the yield was 430, I think, on November 5th. I looked before I came in, it's about 450, 455. This is not a significant move higher in 10-year yields, in my opinion. Short-term rates have come down a little bit more, and we've got a healthier, modestly steep curve. I think that's a good thing. I think the Fed is really going to be all about how quickly the disinflationary storylines come into play. And we've had a very strong view on how that disinflation comes through, both from deregulation, but also from the fact that monetary policy is probably in one of its most restrictive places of the last 3-4 years. Even when rates were up at 5.25 to 5.5, those have been following us at Jefferies know that 2 years ago we were saying policy was very, very much not restrictive, not nearly as restrictive as the rate structure had suggested because of the size of the balance sheet. And I think Mike and I even talked about this at both of our sessions before that we've done. So that balance sheet is now at 6.8 trillion, used to be at 9 trillion. Everything that's been exerting additional stimulative force on the economy that came from the balance sheet side is starting to wane. And we're leaving ourselves with these rates of 4.5, which are, I think, not neutral. In fact, they're quite restrictive. I think we're heading back to 2019 levels of neutral rates. Those are things with 2 handles on them, not with 4 handles on them, as the balance sheet heads back to a level which is consistent with where it was in 2019, which is at about 20% of GDP, and we should be there by mid-year if the Fed keeps going and GDP growth keeps going at these paces. So I think there's a lot of room for the entire yield curve to come down. It'll start with the front end. People will balk at the beginning, and the long end will get a decent steepening. But I do believe long-term interest rates are headed lower and possibly significantly lower over the next 18 to 24 months.
And does the Fed succeed in its dual mandate and keep inflation low and unemployment low?
I'll tell you what, if five-year break-evens couldn't break 2.5% when the CPI was printing 9.1, they're not going to break 2.5% when the CPI hangs out at 2.6 to 2.8 a little longer than people had hoped for. It's just, they did a killer job. Jay nailed it. Jay sat there, watched a 9% inflation hit this economy and the European economy and the Australian economy and virtually every other dollar block economy. And they did the right thing. They got rates higher. They anchored inflation expectations. And here we sit with inflation almost back to where it was, within 50 to 75 basis points of target after a shock that was as large as anything we saw in the 70s, and nobody lost confidence. They're not going to lose confidence in them because we stick around, you know, a 0.25% higher than people thought for an extra quarter or two. So I don't have any issues with a loss of the anchoring of inflation expectations after what they accomplished the last 3 years.
Mike, do you agree?
Yeah, I mean, the Fed has, I think, got their credibility back, the bond market, and I agree, the term premium, while it's gone up a lot from a very low, probably an unsustainably low level, is now a whopping 25 basis points. So that's not out of control, all right? They have not lost control of the back end. And I'm probably more interested in what the new Treasury is going to do. That, to me, that's, like, we know what Jay Powell is. We know what this Fed is. We don't really know what Scott Bessent is about yet. We don't know how much of a hurry he's going to be to correct the front end issuance and what kind of an impact the additional coupon could have in the short term versus the long term. So I'm probably not as confident in the trajectory that the back end will be under control. But I think I have a lot of faith in Scott and Jay Powell. I think both of them together could be quite effective. And it may be messy, okay? And there'll be moments like the fall that we just had where, there's a little tail on a few auctions and the equity market gets a little bit nervous. Because from an equity market standpoint, what you have to remember is valuations are quite high, okay? So there's less tolerance in the equity market for these aberrations, which is why we saw in December, we saw the low quality parts of the market trade off again. And that's one of the reasons we think it's going to be a little more choppy here for the 3-6 months on the equity side.
Well, speaking of equity valuations, let's talk about AI.
Yep.
With DeepSeek yesterday, we saw the market strongly react. It's obviously up today to take back some of the losses, but has the intense bull market associated with AI and all the excitement around what AI could bring to the economy starting to come to an end?
I think it's been ending. And by the way, that's a good thing. Okay, and the reason why it's a good thing is because that also has been crowding out. Okay, you have the government crowding out the broader economy. You have AI, capex, kind of crowding out every other theme that's out there, and it's sort of sucked all the oxygen out of the market into a handful of stocks. So if you go back to last summer and you look at kind of the Mag 7, the two stocks that never made a new high were NVIDIA and Microsoft. Okay, the two poster children for the AI build out between OpenAI and the relationship with Microsoft, and of course NVIDIA getting the benefit of that spending from all the hyperscalers. And so that relative underperformance was telling you that maybe it wasn't sniffing out the deep sea sort of new technology out of China, but it was more about that there's going to be a deceleration in AI capex. It has to. We grew 60% in capex last year. That's going to probably go to something like 25 this year and 10% next year. Well, I mean, these stocks trade off of rate of change. So what that is going to do is it's going to free up capital that's been being crowded into these handful of names into other areas. And we're seeing the beginning of that. So in the fall, best performing sector by far was financials. Financials, I mean, exploded. I mean, we got in front of that in September. We thought it was going to happen because of earnings, and because of the crowding out of the money that was going into some of these AI stocks, that was just fuel for a new theme. And we see more of that. We see it in media and entertainment. We see it in consumer services still, where things are pretty hot, and software. Probably the best pair trade that we've had on is this reversion from semiconductors to software. And that really began in the summer, and that's with Microsoft underperforming. So think about that. And that makes perfect sense. If this new solution from China, okay, is real, and there's some evidence that it is, that means that the compute we need and the energy we need to do this is lower, which means now the application layer can be built cheaply, and it can be diffused into the broader economy, which leads to higher productivity. That's the exciting part of these technology builds. It's not the building of the compute, it's the application layer and the useful tools that then businesses can use to become more productive and more profitable.
So does that fundamentally rewrite the story then? Because, 3 months ago, we were talking about building nuclear reactors next to server farms.
Yes, and that's a good thing, okay? I mean, I never really understood the math on this. It's like, what are we going to tell our citizens? That we're going to build all this power and you're going to have brownouts, because we can do AI and do stuff faster on our phone? It's silly. Technology, okay, is deflationary. Okay, this is the way it always happens. People are like, oh my God, the pricing to rent these, LLMs is going down from $9 to 50 cents. Yeah, exactly. That's Moore's law. That's why it works. And then the technology is affordable to the rest of us. everybody likes to talk about the iPhone in their hand. It's the same, more power than they had on, Apollo 9 or 10 or 11, whatever. I mean, it's like incredible. Well, it's $1,000, and to us it's like 200 because the telcos subsidize it. That's technology at work. So if this didn't happen, and we're going to have to build all these nuclear reactors, well, guess what? It wouldn't happen. So this to me, this is a confirmation that now we can move forward, economically speaking, and then the technology can be actually applied.
Yeah, I mean, if you look at energy production over time, like arguably, if you're producing that much energy, you should expect, a significant amount of economic growth associated with that. This seems like a more rational conversation that we're having right now versus what we were having.
Right. And there will be losers in that, fine. But in the end game, if it didn't happen, you wouldn't have the big winning ticket of why you're doing this in the first place.
So I want to pull out the crystal ball. David, where are we in the economic cycle?
I think we're in the 1980s. I think we've got to be thinking about an almost Reagan-like moment of tearing down 8 years of Obama-led regulations, which really affected our sector, the financial sector, and I don't think Trump got to fixing that during Trump 1, and Biden made that worse, hence what you were saying about the MFA and what you guys are doing. And I think the deregulatory agenda is really repealing 4 years of Biden, 8 years of Obama back. It's kind of like what we had to peel back in the 70s and even in the 60s. And it's just going to have this economy coming up for air and rising significantly higher after that. I just think it's an exciting time to be in risk assets. And it's deflationary in the end because a lot of it's going to come through less regulation and lower cost structures and creative destruction. Don't forget about Schumpeter. And that's what this week should have taught you at DeepSeek. Schumpeter's still out there. There are going to be losers. But you know what? That's in the process of getting us all to a much more productive, much less costly way of growing. And that growth is going to be ubiquitous. And a few people that make buggy whips are going to go by the sidelines. And you know what? They should.
Yeah, I mean, what I was saying backstage was MFA in our 30-year history had never sued a regulator. Under Gensler, we were forced to sue the SEC 3 times. We've won 2 of them. We're waiting for the last verdict.
They'll drop it. Don't worry.
I hope so. Mike, same question to you to close it out.
Yeah, I mean, not to repeat a lot what David said, but I agree. I think it'll be an exciting time for the individual again and companies to have a more open running room, whether it's regulatory, kind of red tape getting out of the way. I think better leadership in general, not just at the presidential level, but I think people are feeling like they've been under this big weight, and the cancel culture, some of that's going away, which is great because people need to argue and debate with each other in the public forum because that's how you get to the right answer. So there's a lot of constraining that's been going on for the last, I'd say 15 years, really starting post-financial crisis, between financial repression and the regulatory changes that came in there. Of course, the flip side is you don't want to let it get too out of control because then you're going to have another financial accident of some kind. So it's we're going to have to balance this. And but as an individual person and as somebody who has kind of lived the American dream, I mean, I'm excited because I think we've underrepresented our people for a long time. I think people have been repressed to some degree, and it's time for mainstream to have some wins.
Please join me in thanking Michael Wilson and David Zervos for their insights.
Thanks, Noah.